I thought that you were gonna turn Blue Star around, not upside down. You fucking used me.
Well, you're walking around blind without a cane, pal. The fool and his money are lucky enough to get together in the first place.
But why do you need to wreck this company?
Because it's wreckable, all right? I took another look at it and I changed my mind.
If these people lose their jobs, they got nowhere to go. My father has worked there for 24 years. I gave him my word.
It's all about bucks, kid.
Beautiful display of capitalism in its purest form, taken to brutal ruthlessness. It's all about bucks, buddy. Wherever money is traded in its various forms, we talk about the financial market. We have here the stock markets, the bond markets, currency markets, derivatives markets, commodity markets and others. It's a spider web of transactions, orders, non-public offers, agreements, insider information under the guise of huge profit, but also huge losses. It's a system that is subject to orders and regulations. It's not always the cleanest game, and maybe that's why all financiers wear suits and ties. Hello on the Invest with Jiri channel. In today's episode we are going to talk about the stock markets. We'll briefly summarize the history of stock markets. How does the stock market work? We'll introduce the most famous stock exchanges, discuss efficiency in the markets. We'll talk about regulators in the markets, the benefits of trading on stock markets, why do private companies go public, how do they work, why are they traded, and why is there so much hype around it? And let's talk about what do stock markets look like today? How did it all begin? Imagine you wanted to move wealth from one continent to another. And you need a fleet of ships to carry the goods. It all costs a lot of money. And you only have limited resources. In order for the whole business to work, you have to find steady source of income somewhere. All fun costs money. This is exactly the way a Dutch company in the 1600s thought and decided to finance the money to build and operate ships through a share in a company called the Dutch East India Company. Incidentally, they got a 21-year monopoly on the trading activities in Asia. That's great. People had the opportunity to get their money's worth and they were free to trade that share on the secondary market. This laid the foundation of the stock market as we know it today. In the past, it was possible to buy shares in a paper form with beautiful decorations and the name of the company. But nowadays, shares on the stock market are traded only in electronic form and nobody trades paper shares anymore. The stock market operates in parallel on several stock exchanges around the world. This means that some of the stocks are traded in parallel in Asia and the US. The markets bring together market participants, which include market makers. They fill in the gaps in supply and demand. Investors, long-term holders, traders, they trade for a few seconds and use sophisticated automated algorithms. Speculators, betting on market events, and hedgers, hedging against market movements with derivatives such as options. They all have the place in the market and they all complement each other. And in all these markets, the shares of private companies are traded by market participants. Trillions of transactions occur daily on each of the listed exchanges, where one owner sells a stock and another buys it, only to have someone else sell and buy the same stock again a few seconds or minutes later. If you are interested in the true value of stock companies, check out my Patreon, link in the description, where I picked and analyzed individual stocks from a fundamental perspective, publish intrinsic value calculators and explain in detail the principles of investing. If you have seen the 1987 movie Wall Street, you might romantically imagine hundreds of small traders shouting at each other that you can tell just by the color of their shirts. And these traders are selling and buying each other's stocks with the help of prearranged gesticulation. You couldn't be farther from the truth. The stock exchanges are empty these days, everywhere is silent, and all transactions are carried out at enormous speeds by the most powerful computers in the world. The most famous stock exchanges are New York Exchange, NYSE, the National Association of Securities Dealers Automated Quotation, Nasdaq, Shanghai Stock Exchange, SSE, European New Exchange Technology, Euronext. If we could eliminate human emotions from trading financial instruments, we could say that stock exchanges are the best place to achieve efficient share price and efficient trading. This is because all market participants have the opportunity to buy or sell a stock at a set price, at a high price efficiency and without waiting. Only in limited cases, for example, when there are panic sell-offs in the markets, it is either impossible to buy or sell a stock, or the exchange may shut down completely for a few minutes or hours. However, the ability to trade efficiently on the stock markets does not mean that there is not a regulator overseeing the overall course of trading on a given stock market. In America, for example, oversight is provided by the Securities and Exchange Commission (SEC) and local regulatory authorities. These regulators make trading on stock markets a safe affair. So, what are the benefits of trading on the stock market? You can always find a counterparty. With many participants, there is a huge amount of liquidity in the markets, ensuring that you have someone to buy from or sell to. Thanks to regulators, stock markets are transparent and it's difficult to manipulate price movements. Although, of course, this does happen. Each of the stock exchanges offers a huge number of traded companies, so we always have a huge choice of investment titles. You can say that you can invest at any time, any amount of money. Let's try to break down why private companies go public. Let's imagine that shoe companies, Nike for example, is looking to finance its growth and is no longer able to finance its growth through its own product sales. It would like to expand because believes in its product. It will therefore issue its shares through the stock exchange in a public offering. This is called an IPO, initial public offering. Market participants buy the shares and thus give money to the issuer, Nike. Over time, the shares rise or fall and trade happily on the open market. In addition, the company may issue quarterly dividends and thus avert the holders of its shares from the company's profits. The regulator keeps a protective hand over the whole process. Now you understand the structure of stock markets, what the largest exchanges are, the efficiency of markets, the participants in the markets, the regulators, and the reasons why companies go public. If you'd like more details about the stock market, feel free to drop me a line in the comments and we can discuss it. If you enjoyed the video, please give it a like. Thanks for watching to the end. Have a great day and invest wisely.